So also you would notice that at this point in time from here now, there were more what? Supply than what? Than demand. So there was more supply than what? Demand. So price was going down. But from this time, from this point in time, this could be 7.00. From this point in time, there was more what? Demand than there was supply. So what? Price started going up. So from this point in time, so this could be 3 o'clock p.m. From this point in time, there was what? More supply than there is demand. What happened? Price started going down. Now you have to understand something. You have what we call demand and then supply. Demand and supply. In economics, this plays different roles. Now, what causes price increments? When there is lesser supply of a particular goods. So let's say we have 10 oranges, right? That's the supply now. We have 10 oranges. And then we have 50 people or 50 individuals trying to buy these oranges. So 50 individuals trying to buy these 10 oranges. And then I'm selling one orange at $1, right? Now, because I see that, oh, many people are demanding for these 10 oranges, I can say, okay, let he with the highest amount of money, let the highest bidder buy. So what am I going to do? I'll now raise the price to what? $2. Now you would see that, those that have them, because there is less supply, people will still what? Rush to buy. So which means, because there is a higher demand and a lesser supply, price will do what? Increase. But then let's say, for instance, I have 100 oranges and then I have 5 people interested in buying, and I know that if I'm selling at $1, they might just want to just buy one, and then the 95 remaining oranges might spoil. What am I going to do? In order to sell out, I might now reduce the price to what? $0.1, which is 1 cent. So what is it going to cost? Like, you see that these people now start buying, like, at least, oh, the person say, oh, it's cheaper. Normally I could have bought this for like $1, so let me buy 10. This person will buy 10, another person will buy 20, another person will buy this. What happened? Price goes down. So when there is less demand and more supply, price does what? So when there is more demand and less supply, what happened? Price go up. When there is lesser demand and there is more supply, what happens? Price goes down. So the same thing here. You see that, let's say this is Euro USD, for instance. So let's say this is Euro USD, for instance. Now Euro USD. So when the price is going down, which means we have for price to be going down, look at this now. We have more of supply, so we have more euro in circulation. We have less demand for euro. So since we have less demand for euro has to be sold cheap. So that is it, selling. So it has to be sold cheap. But then we start saying that, oh, people are now demanding for this euro, but we have limited supply. What happens? Price will now start doing what? Going up. Price will start doing what? Going up. So this is what just drives market. Now imagine when we now go up, the price is now too expensive. So price is going up. Let me not say expensive. So price is going up, and all of a sudden we now start seeing that there is too much demand, because people are now anticipating that maybe the price will like continue going up. People are now anticipating that from here maybe we'll start seeing more like of a move up. So this is what they are anticipating. For instance, okay, let me use another imagery. So they are now anticipating that, oh, this will continue going up. So what do? They now start saying, oh, let's start buying. But then there are, they want to continue buying. Now, if they want to continue, but that is demand, right? So demand is high. They want to just buy. Now, if there was lesser supply, what will happen? Price will go up. Now, what you now see that, oh, we get to this level, they now start seeing that more demand is going down. People are now seeing like it's too expensive, but we have enough to sell. We have enough to sell to you guys, but nobody's interested. What will happen? Price will start going down from here. You see, price will start going down. Now, but what happens when there is a match between demand? We have high demand, and then we have high supply. Price will what? Range to accumulate. We have less demand and less supply. What will happen? Price will range. So that is when we keep going up, we understand like how do we estimate demand and supply? How do we estimate demand and supply? How do institutions estimate demand and supply? And how do normal individuals, retailers, how do they estimate supply and demand? And why do they do that? Because you see, individuals, retailers, they don't have as much information as the producers. So we just find a way to actually want to estimate supply and demand for ourselves. Why institutions have their hands on some certain data to actually understand like the demand and the supply and make the decision off of it, because it's he who goes to the market to buy the raw materials that understands that, okay, there is demand though. Oh, we sold last time, see how much we're able to sell. Oh, that means there is demand. But us, we might not really know, because we're not the main manufacturers, we're not the producers. We don't really understand from their perspective. So we'll find other ways to like gauge it, like supply and support and resistance and all of that. We use moving averages and all of that. So we're actually looking at all of this as we keep going up. But I just want you to understand the mechanism as at how price moves. See, there's nothing different between this and the real world. So it's just that we're now dealing with currencies. Who wants to buy euro and who wants to buy dollar, or who wants to sell euro or who wants to sell dollar. That is just it. And then you are seeing a representation of it in what? A candle. You're just seeing the representation of it in a candle, with the wick being the opposite of this. So the wick are where you are seeing sellers. So here is where you are seeing sellers, and here is where you are seeing what? Buyers. So we are seeing buyers from here, the body. So we call this the body of the candle. We call this the wick, or the shadow of the candle. The shadow. The shadow. So yeah. So I just want you guys to really understand this thing for what it is. Understand it. Don't just see it like something that is gibberish, that it doesn't make sense. This looks so. It's just real life scenarios, economics. I just want it to make sense to you guys. Understand it for what it is. Don't see it like as if we're just speaking gibberish. No, we're not. No, we're not. So I think that's it for now. So as we keep going, I'll keep explaining some certain things, and then keep breaking it down so you guys really understand this series that we're titling From 0 to 100.